Most people think the market only has one game. That is the first mistake. They think the game is simple. Buy productive assets. Stay patient, ignore the noise, keep adding, wait long enough, and the machine rewards you. Now, I believe deeply in productive ownership. I have spent my life proving that patience, discipline, and ownership of good businesses can make an ordinary investor far richer than the culture imagines. But I have also lived long enough to know that the public is usually taught only half of the playbook. It is taught how to behave when the weather is good. It is not taught how wealth actually moves when the weather turns violent. That missing half is expensive. I want to begin with two brothers because sometimes a contrast reveals a truth more clearly than a theory ever could. Years ago, I heard about two men from Ohio who checked their investment accounts on the same Sunday morning. Same family, same upbringing, same general values, same broad income range, same rough savings capacity. Both believed they were doing the responsible thing. Both had been setting money aside steadily. Both thought they understood what it meant to prepare for the future. One of them was doing what the modern world calls sensible. He put money into broad market index funds, automated some retirement contributions, and added a little speculation because everybody around him insisted that a modern portfolio was supposed to contain at least one exciting thing. The other man had listened to an older voice in the family, not a louder voice, an older one, the sort that had seen a few cycles and stopped worshiping whatever the financial media happened to admire that season. He owned some of the broad market too, but he also held a very different set of assets. Assets his brother considered boring, outdated, needlessly cautious, almost embarrassing in a world where people preferred narratives about innovation, disruption, and getting rich without sounding old-fashioned. Then a bad stretch arrived, and on that Sunday morning the first brother saw that despite years of contributions, the machine had not behaved the way he imagined it would. The account was smaller than the total money he had put in, not ruined, not annihilated, just disappointing enough to make him question whether the whole effort had been a beautiful lie. The second brother saw something entirely different. His account had not merely survived, it had moved the other way. While ordinary financial assets were falling, some of what he owned had strengthened, and not by accident. That contrast stayed with me. Not because one brother was smarter in some grand heroic sense, because one brother had been taught that markets only reward you for knowing how to play offense. The other had learned that every serious investor eventually needs a defense. That is the real divide. The public likes to talk as if crashes destroy wealth. That is not quite right. Crashes do destroy some wealth. Of course, bad businesses fail. Overpriced assets get cut down. Leverage snaps necks, weak structures break. But what happens in every major crisis is often better described as a transfer wealth moves. It moves out of what depended too heavily on confidence, liquidity, easy credit, and flattering valuations. It moves toward what can survive distrust, scarcity, stress, and the need for real-world usefulness. That is the pattern. It is old, it is brutal, and it keeps repeating because human beings insist on relearning the same lesson under new branding. I think of every major crisis as having three emotional stages. First comes the collapse itself. Prices fall. People who felt clever begin sounding philosophical. The papers fill with explanations. Broad market indexes lose chunks of value fast enough to make disciplined people doubt their own discipline. Real estate weakens, credit tightens, good assets fall with bad because frightened people do not sell with precision. Then comes the flight. This is the stage most people misunderstand. They think frightened money goes nowhere. It goes somewhere immediately. Pension funds still need a home. Institutions still need a home. Families with serious capital still need a home. Cash is a temporary parking lot, not a final strategy, especially when inflation remains alive in the background. So the money begins moving toward assets with very particular characteristics. They must be scarce in a way that policy cannot easily print away. They must be useful in a way that recession cannot fully cancel. And they must have survived prior episodes well enough that experienced capital trusts the precedent. Then comes the transfer itself. The crowd sells what it believed was safe. The prepared buy what the crowd can no longer hold. By the time recovery becomes obvious, the wealth has already changed hands. This is not theory, this is financial history. The names change, the plumbing changes, the policy language gets updated, the institutions gain new logos and better websites, the pattern remains. In 1929, stocks collapsed and ordinary faith in financial progress was humiliated. The Dow did not just decline, it was crushed. People who had believed they were set for life discovered that a paper fortune can evaporate faster than pride can catch up. Yet in the middle of that catastrophe, certain assets behaved in a way that should have made every serious student of history sit up permanently. One of them was gold mining equities, not gold itself in a vault. The businesses pulling it out of the ground. When the monetary system becomes suspect and trust in paper claims weakens, gold rises in importance because it sits outside ordinary promises. Then the miners, if they are properly positioned, experience the thing investors love most and usually understand least, operating leverage in the right direction. The selling price of the thing they produce rises. The extraction cost does not rise as fast. Margins widen violently. That is why a company like Homestake could become one of the great winners while the wider economy was being humiliated. That is not normal market behavior. That is crisis transfer behavior. Fast forward to 2008 and you see a different cast, but the same skeleton stocks collapsed. Banks failed, housing cracked. The modern world discovered that a financial system can look infinitely complex and still be built on assumptions simple enough to ruin it. Yet again, some assets began doing what they had always done when trust in ordinary structures weakened. Long-dated treasury bonds surged because when private confidence dies, state-backed liquidity acquires new emotional power. Gold and later gold miners did well as the market moved from panic to reflation. The broad world of ordinary risk was being repriced downward. A smaller world of crisis favored assets was being repriced upward. Then came 2020. Different trigger, same structure. A virus instead of a housing machine, a shutdown instead of mortgage leverage. But again, the pattern appeared. Stocks fell hard and fast. Liquidity panicked. Then capital looked for its ancient shelters. Long treasuries ripped upward. Certain defensive businesses held up far better than the broad market. The old hierarchy reappeared almost on schedule. That is why I do not let the public tell me that every crisis is unique in the way that matters most. Every crisis is unique in its costume. Very few are unique in what they reveal about money under pressure. So let me walk you through the 4 categories I would want any serious investor to understand. Not because I think all of them belong in giant size all the time, but because the person who knows only how to own what works in prosperity is half trained at best. The first category is gold-related exposure, especially gold miners. Now I need to be careful because people become silly around gold. They either treat it like a barbarous relic, a dead rock that should be laughed at by modern financial men, or they treat it like a sacred object that should replace all other forms of capital. I have no use for either extreme. Gold does not produce cash flow the way a great business does. It does not innovate. It does not recruit talent or raise prices or delight customers. If you ask me what I would rather own through a century of ordinary productive capitalism, I would still say wonderful businesses. But crises are not ordinary productive capitalism. And in a true crisis, one question suddenly outranks elegance. What is trusted when paper promises begin to smell weaker than they did yesterday? Gold answers that question better than most modern people want to admit. And miners answer a related question better than most modern people understand. If the gold price rises because the monetary system is under doubt, miners can produce results that are much more violent than the metal itself because their economics improve asymmetrically. The market hates them in quiet times. Fine quiet times are not what we are discussing. What matters here is not permanent admiration. It is crisis usefulness. I am not telling you to marry miners. I would not. They are volatile, operationally messy, and subject to management sins like any other extractive business. They are not a buy and forget asset in the way a broad index fund can be, but as part of a crisis toolkit when bought in the right conditions and in measured size. They have a historical pattern that is too strong to dismiss. That is the phrase I want you to remember. Too strong to dismiss. Not safe in every year, not elegant in every environment, too strong to dismiss when the world breaks. The second category is long-duration treasuries. This one bores people, which makes it especially useful. Anything that bores the crowd retains a chance of being priced more honestly than the object. Everybody cannot stop discussing. Long treasuries are not there to thrill you. They are there because in a deflationary scare or any violent collapse in private confidence, the rush toward perceived state, back safety can be so intense that the price action becomes almost a mirror image of what equities are doing. Again, this is not mystical. It is supply, demand, and fear. When panic hits, giant pools of capital still need somewhere to live. They want deep markets, legal clarity, and something that looks as close to a default free anchor as the system can offer. That demand crushes yields and lifts bond prices. The person who already owns the bonds does not need to be a profit in that moment. He simply benefits from having held one of the instruments that frightened money runs toward. That is a very different job from the job equities do, and because it is a different job, it belongs in the conversation. I am not blind to the weakness. Of course, long treasuries are wonderful in deflationary stress and can be miserable in inflationary surprises. We saw that painfully in 2022. Anyone who talks about them as universal protection is just replacing one shallow doctrine with another. I am not interested in doctrines. I am interested in understanding what each category actually protects against. Long treasuries are not an answer to every danger. They are an answer to one specific kind of danger, and they have answered it very well in prior collapses. That matters. The third category is productive land, especially farmland. Now, here is where the modern investor's imagination tends to fail completely. He understands digital assets, perhaps. He understands broad stock ownership, perhaps. But dirt embarrasses him. It sounds provincial, it sounds slow, it sounds like the wrong century. Good. I have noticed that many durable things sound old right before they outperform the cleverer alternatives. Farmland is not exciting in the way a technology stock is exciting. It is exciting in a much ruder and more useful way. People eat that simple fact has outlasted every financial innovation ever created. When money gets weak, when banks wobble, when paper claims are being questioned, the ownership of productive land retains a kind of dignity. The average balance sheet does not. Even if the marked value of land moves around, even if some regions struggle more than others, productive farmland still sits near the root of human necessity. It produces a real thing. It can generate cash flow. It exists outside a great deal of the decorative complexity that confuses modern investors. I do not romanticize farming. It is hard. It is operational. It is cyclical. Weather does not care about your investment thesis, but the category itself deserves more respect than the public. Gives it because it combines scarcity, utility, and a certain independence from the paper layers that can become dangerous in crisis. This is why extremely wealthy people so often own land quietly. They may not talk about it at cocktail parties. They may not put it on magazine covers. They understand that land does not need applause. It needs productivity for an ordinary investor. Publicly traded farmland vehicles may be one way in, though each one must still be evaluated as a business and not treated as magical dirt in a ticker symbol. The wrapper matters less than the underlying economics. That is a rule in every asset class. Still, if you want to understand how wealth behaves when the system is under strain, you must learn to respect productive land. The fourth category is consumer staples and similar essential businesses. This is where many people make a different mistake. They think crisis assets must all be dramatic. They think the protection must come from gold or bonds or something visibly defensive. Sometimes it comes from boredom. Toothpaste, soap, groceries, household staples, retailers so basic they feel beneath the attention of the average speculator. That is precisely the point. When life gets hard, people still brush their teeth, they still eat, they still buy cleaning supplies, they still keep children fed. The broad economy can wobble badly, and these habits remain. That does not make every consumer staple company a bargain. It does make the category structurally different from the businesses whose revenues evaporate as soon as households grow frightened. I have always admired businesses tied to repetitive human behavior, especially when the products are cheap relative to the customer's daily life and protected by habit, brand, or distribution. In a crisis, those qualities matter even more. The market stops paying for hope and starts paying for reliability. This is why staples usually do not produce the most dramatic upside in a collapse. They do something more useful. They lose less, stabilize sooner, and allow the owner to remain invested in productive enterprise without feeling as though every part of the portfolio is being fed into a furnace. People underestimate the value of losing less. A portfolio down 50% must double to recover. A portfolio down 28% needs much less heroic help. This is arithmetic, not philosophy. Now, when you put these four categories together, the deeper principle emerges. They are different from each other on the surface. Miners are not treasuries. Treasuries are not farmland. Farmland is not Procter & Gamble or Costco. But all four, in their own way, answer the same crisis question. What remains trusted, useful, or necessary when confidence in ordinary growth assets breaks? That is the real question. And if your entire portfolio is built only for prosperity, you have not answered it. Most people build exactly that portfolio. They own the broad market, they own a few growth names, perhaps they own some real estate in whatever fashionable city people were praising. Maybe they own crypto because somebody shamed them into believing that modern people must fine. Perhaps in long bull markets that portfolio feels intelligent. What happens when the world enters a different regime? What happens when rates spike, liquidity disappears, credit tightens, unemployment rises, or confidence breaks? Then the portfolio reveals whether it was a real structure or simply a prosperity costume. I do not say this to frighten you. I say it because every crisis eventually humiliates the investor who thought good weather was permanent. The right response is not panic and not prophecy. It is preparation. There is no virtue in calling the date of the next crash. People love that sort of drama because it feels like power. I have never had much respect for people who pretend to know the exact hour of a storm. It is enough to know what storms do to weak structures and what they reward in stronger ones. If I were looking at an ordinary American household portfolio today, I would ask a few direct questions. What percentage of this capital benefits if growth continues? What percentage holds up if growth stalls? What percentage strengthens if a real crisis arrives? What percentage depends entirely on confidence staying high? What percentage is there to keep the owner sane enough not to sell the whole machine at the worst possible moment? Those are adult questions. The average portfolio has very bad answers. That is the problem. People are being handed half a playbook and told it is wisdom. They are told to buy broad indexes, ignore everything else, and trust that time heals all wounds. Time does heal many wounds. I believe in time deeply. But time works best for those who remain in the game. A structure that can survive stress makes it easier to remain in the game. A structure built only for bull markets makes that harder. That is why I think of crisis assets not as predictions, but as position sizing for human weakness. When the world gets ugly, do you want some part of your account moving in a direction that restores your ability to think calmly? Yes, that is what these assets can do. They are not only financial tools, they are behavioral anchors. A person watching a total portfolio collapse often becomes emotional and irrational. A person seeing one sleeve of his structure hold up or even strengthen has a chance to behave like an owner rather than a victim. That chance is worth a great deal. There's another reason this matters. Now, the current world is full of exactly the kind of fragility people ignore when the S&P 500 is behaving. Well, debt is large. Commercial real estate still has unresolved problems. Household finances are weaker than appearances suggest in many places. Credit card balances are high. Government deficits are normal in a way that earlier generations would have found appalling. Geopolitical strain exists almost everywhere. One looks, the yield curve has already told us enough over the years to deserve respect. Credit spreads matter. Labor weakness, once it starts, usually means more than the crowd wants it to. I am not predicting a collapse on a calendar. I am saying the conditions that make second playbook assets relevant are not fantasies. They are live possibilities. So what would I do? I would not swing wildly. I would not sell every broad index fund and hide in a bunker of gold miners and canned goods. That is childish prosperity. Assets still matter. Productive enterprise still matters. Over long periods, capitalism still rewards ownership. But I would stop pretending the first playbook is enough. A measured portion of a serious portfolio can be allocated to the kinds of assets that have historically strengthened or held better when the ordinary machinery of confidence breaks. That is not pessimism. That is completeness. How much that depends on the person. Age matters, income stability matters, temperament matters, existing exposures matter. Someone younger with strong earnings power and iron nerves can hold less crisis protection than a retiree, depending on the portfolio to fund actual life. Someone with a concentrated business exposure already tied to economic growth may need more defense than someone whose income is unusually stable. There is no universal number that turns a human problem into a neat formula. What matters is not the exact percentage. What matters is that the portfolio contains some exposure to the world that benefits when most people are only prepared for the opposite. This is why I like the grandfather and the brothers example. He had not left them a hot tip. He had left them memory, a memory of what financial systems do to people who think wealth only comes from one direction. Old people who have lived through real breaks often sound boring to the young. They repeat themselves, they seem overly cautious, they admire odd things, they talk about gold, land, and ballast when the young want growth, speed, and leverage. Then the cycle turns, and suddenly the old man no longer sounds boring. He sounds expensive to have ignored. I am not trying to turn you into a pessimist. I am trying to make you complete. That is the whole objective. A complete investor knows how to benefit from prosperity and survive panic. An incomplete investor only knows one of those jobs. The market can be generous for long periods and still demand a fee eventually from people who prepared only for generosity. Do not pay that fee unnecessarily. Own great productive businesses. Yes, own broad, low-cost index exposure. Yes, but also respect scarcity, respect safety that becomes more valuable when private confidence evaporates. Respect productive land, respect boring staples, respect the fact that every crisis rearranges not only prices but psychology. And above all, remember this: the investor who survives every storm eventually gets to keep compounding. The one who is wiped out or emotionally broken or forced into terrible decisions because he built only for sunshine does not get the luxury of using time as an ally. That is why the second playbook matters so much. Not because fear should dominate your life, because survival should, and survival over long enough stretches becomes one of the greatest compounding advantages in the world.